how does price actually move? What is the key factor? Supply and demand, algo, macros. Okay. What else? What is the key factor that drives price in the charts, on the charts? What is the reason? Moht cave. Excellent. Bid and ask. That's exactly how price moves in the markets. Okay. So first of all, we need to understand that markets are basically an open auction. It's a continuous auction process where price discovery occurs through the interaction of buyers and sellers. Okay? This is not merely a metaphor, it's actually the mechanism that drives every single price movement that you observe on the charts. Okay? And I'm going to just give you a simple um, illustration now. Okay? So let's just imagine that we have a range. Okay? This is going to be our range. Let me just change the color. I'm going to make this, I don't know, let's make this yellow. Okay? This is going to be our range that price moves in between. Okay? Just imagine that you have an auction of, let's say, a car. Okay? Let's say there's an auction on a BMW, the BMW in German. It's actually BMW, not BMW. Okay? Or Mercedes or Volkswagen or whatever. There's an auction. Okay? This could be even like arts that are going to be sold. And we're going to have buyers and sellers in this auction. Okay? So we're going to have buyers and sellers. So anything that's going to be sold, it's going to have a minimum price and a maximum price. We're going to call the maximum price premium. So I'm going to add another box here. This is going to be our premium price. And then we're going to have a, a minimum price, which is going to be the discount. Okay? Just imagine anything that you buy or that you want to sell, you want to buy for a low price, of course, and you want to sell it for a high price. So let's imagine that you want to buy an iPhone. Okay? And you know that the equilibrium price, which is the average price of an iPhone 17 Pro. What's the price of an iPhone 17 Pro? What is it? I don't even know. What's the price of an iPhone 17 Pro, guys? Okay, so let's just assume it's 100, it's 1200. Okay? This is going to be the equilibrium price, or we also call this the fair value. Okay? It's the fair value. If you have an iPhone, would you be willing to sell the iPhone for the fair value, or would you want to sell it for a higher price? What's the correct answer? So you have an iPhone. Do you want to sell it for $1,000, $1,200, or do you want to sell it for 1,500? Exactly. Okay. So what you want to do, you want to sell the price for, let's say, 1,500. That's going to be the premium price. So you can imagine that at the premium price, we're going to have a lot of sellers. Okay. This particular price is going to have a lot of sellers. Okay. But it's not going to have a lot of people who want to buy the iPhone for $1,800 or $1,500 because that's the premium price. Okay. So imagine you have an iPhone and you want to sell it for 1,800. What do? Imagine you're on an open auction. You're basically looking for someone, just anyone, who is willing to buy that iPhone for $1,800. Okay, so we're just gonna assume that this is 1,800. and then the discount could be 600. Okay? That's the discount price, and then 1800 is going to be the premium price. Okay? All right, guys. So what's going to happen? What is going to happen if you want to sell the iPhone for $1,800, but you find no one who is actually willing to buy the iPhone for that price? What's going to happen? What are you going to do? Okay, Abdullah says he wants to wait. Okay. So you want to sell the iPhone, and then you'll have buyers who are basically bidding prices on that iPhone. Okay. You want to find the next customer who wants to buy the iPhone for any price that is lower than the 1800. Okay. So let's say you have 100 buyers, and one of them says that he wants to buy the iPhone for 1700. What are you going to do? You're going to sell your iPhone for that price. Okay. And this is just imagine that this is actually happening on a macro level. So you're not the only seller, but there are 100, 1,000, maybe 1,000,000 sellers on the market that are constantly looking for buyers who wanna who are basically offering a high price, which is lower than 1800 for that iPhone. Okay. So when that happens, when you actually find the customer, the buyer who wants to buy the iPhone for 1700, a new price is being established in the market. A new price is being established, which is why we're saying that in the markets, how price moves is actually a price discovery. The new price of 1700 is being established, is being discovered now. Okay? All right, once the price actually sits at 1800, so imagine that all these people, all these sellers who insisted to sell the iPhone for 1800, do you think they're just gonna wait? What are they gonna do? If the first seller, you're the first seller who sold the iPhone for 1700, what are all these sellers gonna do? What are they gonna do? Are they just gonna wait for price to come up for a seller, a buyer who wants to buy the same product for 1800? What are they gonna do? Exactly. They're gonna drop the price. Okay, and they're gonna look for the next customer, for the next seller who wants to buy the car, the iPhone for 1700 or even 1600, like six 1650 dollars. Okay, so they're gonna decrease the price until they fill their order. Okay, until they can sell their iPhone. Because what happens when price drops? This is enticing sellers to decrease their price because now they're in FOMO. Okay? They're in FOMO. They don't want to miss out on this opportunity to sell their iPhone because they're assuming that the price is going to go lower even more. Okay? So they're thinking instead of waiting, instead of insisting on my price of 1800, I'm afraid that the price is gonna decrease even more up to 600. And I don't want to miss out on the fact that price is at 700 right now. So I'm gonna try to sell everything that I have because I want to make profits. And then once price drops, I want to buy. Okay? I want to sell now. Once price drops, I want to buy. And then I want to sell again until price actually reaches an equilibrium of $1,200. Okay? This FOMO in turn is gonna lower the price even more because more and more people want to sell this iPhone. So we're gonna have more sellers at the top of this range than buyers. Okay? Which is why price drops. So if I have 1,000,000 iPhones in my house. Okay. So I have 1 million iPhones. I have 1 million iPhones, and I want to sell all of them. I'm not going to be able to sell all iPhones at once for $700. Okay? Because at $700, I might be able to find 200,000 customers. Okay? And then at 1,650, I might be able to find another 300,000 customers. Okay? And then at 1,500, I might be able to sell the rest of $500,000. Okay? Which is how these banks actually operate. I'm just giving you this analogy so that you understand what's happening on a micro level. Okay? Good. This is exactly, guys, how price moves in the financial markets. The only difference is we don't have a specific product like a car or an iPhone. What we have is a financial instrument. Okay. So if we look at the gold chart, for instance, so this is the premium price would be at 3,980. Okay, just for argument's sake. And then the discount price would be 3,613. Okay. And we're going to have buyers and sellers, which is volume. Okay. We're going to have buyers and sellers on each single tick. On each single tick, we're going to have a certain amount of orders, a certain amount of buyers or sellers. Okay. And what is going to happen? Sometimes we're going to have a gap. Okay. We also call it imbalance. What that is basically as follows. I'm just going to give you guys an example. Okay. So this is the GBP JPY chart. What we're seeing here, this is the VRVP, which is the volume range, visible range volume profile. It shows us where most of the transactions were made in this specific market. And as you guys can see, we have a high volume here, sitting at 210.750, and then we have a high volume here, and in between them we just see a jump. Price basically just jumped through these areas of interest. Okay, why is that? Because within that range, we didn't have any order sitting. Okay, we didn't have any sellers who wanted to sell the price for that the instrument for that price. So price just jumped through the two areas of interest, points of interest. Okay, good. Do you guys have any questions so far? Do you guys have any questions so far? Okay. Now we have to address one more thing. We have to address liquidity. Okay. So let me just open up an example. Let's just go back to the presentation here. Okay. Good. So we've understood that market is just an auction where buyers and sellers are bidding on prices and they're trying to establish an equilibrium. Okay. Which is what actually makes price move. Good. Now, the second concept that we have to understand is liquidity. Now, liquidity is fuel for any specific price movement. Okay? Liquidity represents orders waiting to be filled, resting buy and sell orders that provide the fuel price that is needed to move. Okay? And we have buy side liquidity and sell side liquidity. And I'm just gonna give you guys one more illustration. Okay? So let's just imagine that we have an accumulation phase. Okay? So we have something like this. And let's just assume that what the big institutions, what the banks want to do is they want to move price to the upside. That's what they want to do. Okay. So they want to move price to the upside. The problem is they can't just, enter 10,000 or 10 million lots. They can't just enter a position here and go long with, let's say, 10 million lots. Okay, just think back of the analogy that I gave you with the um, what was it? Where you were selling iPhones, right? A specific amount of iPhones at every single tick, at every single price. Okay, so they can't just do that. Why? Because they don't have the counterparty. They don't have enough sellers sitting at those specific ticks. Okay, which is why if they just entered, so how they're operating is basically like this. They want to buy 10 million lots. Okay. They can't do that at this tick. So they're going to buy here, let's say 200,000 lots. And then they're going to enter another position at the next tick, which is going to be any amount of orders that they can fill at this tick. And then they're going to have their next position one tick above. They're going to have the next position one tick above until they actually have bought 200 million lots, okay, or 20 million lot, or whatever the maximum size of the lot size is. They can't do that because they don't have enough liquidity. They don't have enough orders that are sitting at those ticks, which is why they can't just enter that amount of lot sizes and then move the price. Okay. So what they're trying to do, what they want to do is they want to sweep the liquidity. What they do, they're basically printing this accumulation. They're actively printing this accumulation. And what we're going to have in any single phase of accumulation is, what is it? Where's my, just a second. Right. Any type of liquidity or any type of trend line, liquidity is going to be built. Okay, so they're printing this accumulation to entice retail traders, which is us, okay, to basically go with market structure and then put their positions here at these two zones. Okay, so what most retail traders are going to do, they're going to watch a few YouTube videos and then they're going to say, oh, we have a resistance here and we have a support here. So I'm going to just put my my position here. I'm going to put my, what is it? My sell limits sitting at the zone. I'm going to put my stop loss just right above this zone, and I'm going to target the 10 to 1, whatever. Okay. And then breakout traders, they're going to put their buy stops at this same zone. So they're going to say, once price actually breaks through this resistance zone, I want to put a buy stop there. Okay. So they're putting their positions here. And they're saying, okay, once price actually breaks through this zone, I'm going to put my stop loss beneath the resistance, because the resistance was broken and now it's going to function as a support. I'm going to put my stop loss here, and then I'm going to target whatever 10 to 1s, 50 to 1s, whatever. Okay. And so this is going to be called, this is sell side liquidity. Okay. This is buy side liquidity. I'm sorry. This is buy side liquidity. The exact same thing is going to happen here at the support zone. Okay. So you can just imagine this is our range. So this is our range. The zone above, that's the premium price. This is going to be our discount price. And this is going to entice retail traders to put their positions even at the support zone here. Okay, so they're going to say, okay, I'm going to put my buy limits here, my stop loss just underneath the, the support. And then I'm going to put my sell stop at the exact same zone. So once my first position actually gets stopped out, I'm going to assume that this zone was broken, and then my sell stop is going to get activated. So because the banks know this, What they're going to do is they're going to manipulate. They're going to sweep this liquidity. So they're going to stop out all these buy limits. At the same time, they're going to activate these sell stops. So just imagine this is being stopped out. This sell stop is being activated. And then they're going to actually move. So they're going to sweep this liquidity, grab this liquidity so that now they're in a position where they can actually enter the position of 20 million lots or whatever. And then that amount of lot size is going to move the price. It's going to give the impulse to the upside. So what we're trying to do as smart money traders, we don't want to put any orders here because that's too obvious. And we know that if something is too obvious, if we have a strong supply and demand, okay, if we have a strong support and resistance, we don't want to enter our positions yet, okay, because we know that the more obvious something is, the more liquidity is going to sit at those zones, okay? So we're going to have a liquidity pool that is sitting at those zones. So we want to wait until the liquidity is being swept. Once liquidity is being swept and we see a huge impulse, we want to look for entries if price comes and corrects even further down to the Fibonacci level, but that's an issue, a topic for another time, okay? So that's going to be my entry. I'm not going to enter any positions until I actually see how manipulation is done, how the impulse has come, and then how price corrects back to this discount level, to this support zone, okay? Good. Does anyone have any question on liquidity so far? Exactly. So this is how a liquidity sweep or liquidity grab looks like. Okay, it occurs when price briefly pushes through an obvious high or low, or even a trend line, triggering clusters of stop loss orders before reversing sharply. Okay. 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 Can you guys hear me? Good. These sweeps serve a purpose. They provide liquidity necessary for large players to enter or exit positions. Okay. And by triggering stop losses clustered at technical levels like support and resistance, institutions now access the order flow they need for meaningful positioning. Okay. So these sweeps are not evil, they're intentional, and they're necessary for price to give us huge moves. So whenever you see a huge move in the market, let me just give you guys an example here. Okay. Let's just, as an example, just go to this chart here. This is actually from our course, but we're not getting into that. So anytime we see a huge impulse in the market, we see a huge impulse, what the banks need is liquidity. Okay. The banks need liquidity. So let's just give an example here. We might actually find an example. Okay. So this was our support. Okay. This is one example. Okay. So what we're seeing here, we can see that this resistance was broken, right? This resistance was broken. And then the same zone actually functioned as a support zone. You can see that at this same level, price rejected a few times. So this was our support zone, okay? Once this was broken, the same zone actually functioned as resistance now. If you just pay attention here, what we have here is you can see that multiple candles, okay? This is something that we would call double top, triple top, okay? We can see that these candles actually stopped. They wicked into this specific price, okay? What do you think this is going to do? What this is going to do is very simple. Retail traders, they're going to put their sell limits right at this price, okay? And then they're going to put their stop loss just above these wicks, and then they will target huge risk to rewards, okay? And what happened here was price actually came back, retested the zone, but actually wicked all these positions out. All these positions that were sitting here were wicked out, they were stopped out, and then price gave us the actual impulse. Okay. So we don't want to be um, stopped. Like basically we don't want to be hunted. We don't want to be the retail traders that are hunted at this price level. We want the liquidity sweep to occur. And then once price actually comes back to this zone, and only if it does, okay, only if it price actually comes back to this zone, because we know that once the liquidity sweep is established, this is going to function as a new resistance now. Okay, this is because the liquidity was swept, so the banks do not need to sweep even more liquidity if price wants to go back. Okay. And then we can actually combine this with different elements that we teach within our community. So this would be, for instance, okay, what we could do, we could actually draw this auto block here, and then we could look for a harmonic pattern. So this would be our harmonic pattern, okay, which is okay. This is our harmonic pattern. And then we can see that price actually came back to the order block. And then this would be an A plus textbook setup, guys. I mean, honestly, this would be, I would have just taken this position because I clearly see that liquidity was swept. We have built a resistance zone. And then we had a change of character, breakout, a break of structure to the downside. And following that, we had a harmonic pattern coming back to the 0.78. Okay. And then this could have given us a clean 3-1, even 6-1, because what I would do, I would target the minus 0.27 Fibonacci level. So what we would do would probably be something like this. Okay. We're using our Fibonacci tool, and then we're targeting the minus 0.27 Fibonacci level. And what happens often in the markets is price actually just taps into this Fibonacci level, this Fibonacci extension. We call this Fibonacci extension, which is minus 0.27, and then gives a small reaction, a pullback. Okay. It's going to give us a pullback. So I want to close all my positions here at this level, the take profit one, which is the previous low. And then my take profit two is going to be the Fibonacci extension of minus 0.27. All right, guys. So yeah, we're not going to get into harmonic patterns today, but this is basically how we're entering and executing our trades and positions, okay? Which is why we have a huge risk to reward, because we're looking for key areas, key entries that give us the perfect sniper entry in these markets, okay? Good. Has anyone any question on liquidity so far? So Alex says yes. Abdullah says no. All right. Good. I'm just going to give you guys an example from the charts. This was actually a trade that we took, I think, 3 weeks ago. So what we've seen here in the 4-hour time frame was that we've built a range. Okay, we have built this range, which means that I'm looking for buys at the discount price. Okay, I'm going to look for a buy at this discount price. So price tapped into this discount price, and then what I want to do is I want to jump into the 5 minute time frame, the lower time frame. Okay, And what we've seen here, because now we've established that price might want to go up again, okay, because we're sitting at the discount price. But I don't want to jump into the trade yet because I want to get into the sniper entry in the low time frame. What we're seeing here is price actually builds something like an accumulation phase here. Can you guys see that? So this is our accumulation. Okay. So we have a liquidity pool sitting here. We have liquidity sitting at the bottom. So we can imagine that if smart money, which is the big institutions, the banks, want to give us the move upwards, they need to grab the liquidity first before they actually give us the impulse, which is exactly what happens. The liquidity was swept, okay, was grabbed, and then we had a huge impulse. So this is going to be our order block, and this huge impulse actually left a fair value gap. These are all concepts that are all, additional confirmations that we're looking for to enter a specific trade. Okay. Liquidity was swept, and then we had the main impulse. And following the impulse, we had three-step correction, a three-step correction. And at the same time, this was actually a harmonic pattern, and price came back and tapped into our order block. Okay. The next stage then is the strategy, of course, right? So the entry is going to be the zero point 0.5 of my order block. I'm going to put my stop loss beneath it, and then I'm going to target the minus 0.27 Fibonacci level, the Fibonacci extension of this main impulse. This is my Fibonacci tool, the low, the high, and then this is going to be the Fibonacci extension of minus 0.27. I'm in the trade. This trade would have taken about 2 hours, 3 hours, and then I'm in and I'm out. Okay, that's all I want to do. I want to get into the trades in the lower time frame, in the 1 minute, 5 minute time frame. I want to get in and I want to get out. And this is just one example, guys. I mean, these patterns, these textbook scenarios basically happen over and over again. Okay, so for instance, I mean, we had one trade here. This was, I think, last Friday. I think this was last Friday. I could just go on and on here. We have something similar. Liquidity was swept, and then we had a harmonic pattern in the 1 minute time frame, giving us a clean 9 to 1. These are more simpler market structure trades. But then I could just go on and on here, for instance, right? We can see we have an accumulation, something like an accumulation here. Okay, and then liquidity swept. We have an order block. Price actually comes back to the order block and then gives us a clean 4 to 1, 5 to 1. Okay, so these are just some concepts that you need to understand, guys, in order to be able to read the chart. Okay, how is liquidity being pooled and built? How are these key zones, supply and demand zones, being swept? And then we want to see a huge impulse following that liquidity sweep, and then the correction back to the order block that caused the main impulse. Okay, good. So this is basically the market cycle. Before any huge impulse, what the markets do, they build an accumulation phase. So price is being consolidated, which builds liquidity. And then liquidity is being swept, is being grabbed, which we call manipulation. And then we have the distribution, which is the initial impulse. Okay. So this, in this instance, just to give you this, I'm just going to show you guys this here. Okay. So we're going to have the accumulation phase, which is going to be something like this. This accumulation is going to be the liquidity that's built at the top and the bottom is being swept. Okay, we also call this a fake out. And then we have a distribution. Following the distribution, we have a correction. And following that correction, we have the main expansion. So we want to get into the trades at this specific phase. We want to target, catch this main expansion that is being executed by smart money following the script. Okay, that's where I want to be in the trade. The expansion phase, when the momentum actually has built. So I don't need to chase anything anymore. Okay, because price has given me its intention, liquidity is being swept, and then I want to just find the perfect sniper entry. I want to get into the trades, get out within a couple of minutes, sometimes a couple of hours. Okay. I don't want to wait for a trade to play out for 3 days. I don't want to do that. Some people are swing traders. If you can do that and not lose your patience, all respect to you, I can't do that. I want to get into the trades and be done within half an hour, 1 hour, half an hour, 1 hour, 2 hours. Okay. So yeah, this is the market cycle, guys. Manipulation, accumulation, liquidity sweep, distribution, pullback or correction, and then the expansion phase. Okay, good. Do you guys have any questions? Okay, Alex says, can we take entry before liquidity sweep? Um, Alex, you can do anything. You can do anything. Um, what I'm just giving you guys is one strategy from 100 strategies. So let's imagine that you're a support and resistance trader. Okay. So let's just jump back to this example. Just a second. Good. Okay, so let's just assume that you are a support and resistance trader. So you have the support zone and the resistance zone, okay? All you're doing is just looking for support and resistance, and then you want to enter your cells, okay? In this case, I'm just gonna illustrate, make a new drawing, okay? So imagine that this is a resistance zone and this is your support. How do you know? Because price tapped into this zone, rejected a few times. Okay. I, as a smart money trader, I'm gonna see liquidity being built here. You, as a support resistance trader, you could just enter your positions here. Okay. And you can just try to get the move by just repeating it over and over and over again. So you might be able to catch this one of these moves, and then the next time you're going to get stopped out. And you could still be profitable. Okay? You could still, because if price actually rejects you a couple of times, you're going to be able to catch the trade a couple of times. Okay? Now, me personally, I wouldn't do it because at this zone, I would want to see an additional confirmation, like an M15 engulfing or something, and then I would enter the trade. You could do that as well. Okay. Someone is drawing on the chart. Please don't do that. I'm just giving you a tool, guys, okay, that you can use to increase your win rates and to increase your risk to rewards. That's it. Okay. So trendline trading, does that work? Probably. Support resistance trading, does that work? Probably. Okay. We are recording this, Fahim. Yes. Okay. Do you guys have any additional questions on liquidity, on accumulation, on market auction theory, on how price moves, and all the additional stuff? Okay. All clear. So I'm just gonna leave the stage to Aurora, and she's gonna continue.
Okay, can everybody see me? I hope so. So now that we've done a little bit of technical, theoretical stuff, I just wanted to take the last like 10, 15 minutes to talk about practical things, which are your plans, your goals. Because in the past couple of days and in the couple of weeks, especially like in this January phase, we've talked to a lot of people, and we've also had a couple of calls with people who blew their accounts, who had pretty tough times, who are don't really have a plan, not really have goals, right? So, for example, many people just trade just to say that they trade, or just to say that I want to be rich, but they don't even have a plan on how that looks like, on how they expect from trading. What are your expectations from trading? Can anybody share what their expectations are from trading? Do you expect to make $100 a week, $1,000 a month, $1 million a year? Like, what are your expectations? Freedom, consistent. See, for example, terms like this, freedom, consistent freedom. What is freedom for you? Because if you live like in a country, let's say like the US or let's say Germany, freedom would mean 20,000 euros a month, 30,000 euros a month. That would mean freedom in Western countries. In other countries, it may look different. What does freedom mean to you? Put that in dollars, put that in golds. $100 per week. Okay. What about the others? Becoming a profitable trader and source of income for others. What do you mean by profitable trader? Because you are a profitable trader if you make $5 a week because you make money, right? You only make $5, but you're a profitable trader. Like, on what scale should that profitability be? What are your expectations in a month and half a year?
Okay, can I just ask you guys a question? So I'm going to show you something because Aurora just said what is um, consistency and profitability. So these are our statistics from the last 7 months. So these are the numbers, okay, the exact numbers that are the results of our trades that we have posted in this group. August was 29, September was 24, October was 40%, December 22 to 28, November 34, and then this month we actually had a losing month of -4%. Question: is this consistency? Is this profitability? And if yes, why? Because we've had guys in the group, guys and girls, who have blown their accounts this month. Let me look at the chats. Sure, because of good psychology. I don't know what that means for him. What do you mean? Because their risk management sucks because you're not over trading. Mm-hmm. Mm-hmm. Exactly. The risk management. Here's a thing that I've realized in how most people trade. If you have, look, if you're on a prop firm challenge, okay, and you're losing 1 to 2% on every single trade, one simple losing streak is going to blow the account. What I want is, after all of these wins the last couple of months, okay, what I don't want to do, I don't want to just pay out all of the profits that I've made in the last couple of months. Because if I do that, I won't have any buffer in the account for a losing streak. And a losing streak is gonna come, guys. I mean, I don't care how profitable, I don't care how much of a chart nerd you are. Any trader, at least a couple of times in their trading career, they're gonna have a losing streak of 5 to 10 losses in a row. It's just inevitable. Because sometimes, like the charts does just don't make any sense. I mean, they're hitting your stop loss, they're wicking you out and then going into profits, which is what exactly the moments that the markets are actually testing your patience and your loyalty towards your own strategy. Okay? Because after a losing month, if I'm now changing my whole strategy, okay, and the charts actually do deliver what I'm looking for, I'm not going to make the exact same profits. If I play with my stop loss, with my risk to reward, I'm not going to make the same profits the next month. So what I need to do, I need to stay calm during such a period and just remain to my freaking strategy. Just, stay insistent and just repeat over and over and over again and not change anything in my risk management. Okay? Today got 3 stop losses. Okay, Alex, why are you trading on a Sunday, man? India markets, okay? So why are you trading on a Sunday? What are you trading crypto?
Okay, so you guys hopefully got the point. Consistency doesn't mean that you're always winning. It means that you're always doing the same thing over and over again, because in the big numbers, it goes well. But if you have a good edge, if you have a good strategy which performs really well, and you are used to getting a lot of blue months, month after month, which is also why a couple of people in our group blew their accounts, because they were so sure that after 5 months of consistent profits, it's impossible for you to have a red month. It's impossible for you to make losses. And what do? They overtrade, they increase their risk, they push their stop losses, they enter trades which aren't even good. So they do a lot of mistakes, not because the strategy doesn't even work, but because their mind is, their arrogance, their ego is pushing them to go into the market. Because how can it be that after so many months of figuring the markets out and making so many profits, how is it possible that this month is a red one? The next trade is going to be 20 to 1. The next trade is going to be a 10 to 1. The next trade is going to be a 5 to 1. They keep going in with that mindset and over leverage, over risk, over trade. So no matter if you have a blue month or a red month, you always have to stay humble in your strategy, because the market can do whatever it wants in a month. It can give you a red month, it can give you a 40% month. So you just have to have that mindset that when you go into a trade, this one is probably going to go in a loss. That should be your mindset. And when it does go in a loss, you should be able to handle that, because the risk that you put in should have been calculated. You should be able to accept that loss at the end. So that is one thing. The other thing is, for example, let's say we had a talk with somebody a couple of months ago, and she said that her goal was to make $50,000 a month. And we asked her how she was trying to achieve that. And her answer was, well, I'm currently doing a 10K challenge. Do you guys see a problem there? Do you guys see a problem in somebody saying, I want to earn $50,000 a month? And the way I'm trying to do that is by doing a 10K prop firm challenge for like a couple of months. unreal, a little bit delusional as well, because you have to be realistic with your goals as well. So for example, if you say I want to earn $1,000 a month, then I should calculate, okay, let's say I have a strategy which gives me 5% a month. Okay, if I have 5% a month, what would 1,000 be? It would be like $200 risk. Okay, how big should my account be so that I can take a $200 risk and not be scared of blowing my account the whole time? Should it be $2,000, $5,000, $7,000? How big should my capital be for me to consistently achieve that result? If you go in with a $100 account and you want to earn $500 a month, then you're basically 6xing your account every month, doing 600%, 500% plus, and then withdrawing all that money and starting again with $100. So you should make a real plan in real numbers, not just talk about financial freedom, not just talk about independence, not just talk about something vague and undefined. Define what you want to achieve in 3 months, in 6 months, in 1 year. And then plan accordingly. Plan your capital accordingly, plan your risk accordingly, and keep yourself accountable.
I always tell my guys, the solution, if any one of you overtrades, the solution to that is depositing enough money that you respect. And that is very individual. Okay. So let's say $200,000 is a capital that I personally do respect. Okay. I'm not going to overtrade because I'm going to risk $2,000, sometimes four, $5,000, $6,000 on one single trade. That's just is going to stop me from overtrading. You know what, guys? Anyone that actually invests in coaching with me or Aurora, they don't overtrade. They stop overtrading in like 3, 4 weeks. Because why? Because they've invested money that they actually do respect, right? Whereas anyone who wants to flip their accounts, they don't want to buy challenges, they don't want to put any money into their account, they don't want to invest in mentorship. They're just wasting time most of the time for 6 months, a year, 2 years. I've just had a guy who came to a call and he said he just blew $30,000. And then I said, okay, good. Here's the two options. You can join our mentorship or you can join just our community, which is a bit cheaper. You can start there. You can make your money through the signals, the trade ideas, and then with that money, you can invest in either you can deposit it into a life account or you can invest in coaching. And I told him, close your positions, pay out, just pay out the money, bro. Just pay out, just pay at least half of the money because that's real money. You could buy a Porsche with that money. Okay. He didn't do that because right? And then what he did, 2 days, I didn't even tell him anymore to invest in coaching because I've lost hope at that point. But then the next day he just blew $40,000. Okay. So this shit happens, guys. I mean, you need a plan, you need a program that keeps you accountable and that you actually do respect. Yeah, do. Exactly. Yeah.
We also had another call yesterday of someone who passed like 6 or 7 prop firm challenges, who had a $40,000 payout, a $40,000 payout in like 3 or 4 months. He put it in the live account, he couldn't control himself and blew everything. I'm just trying to tell you people, I mean, it's important that you respect whatever you're doing. It's important that you respect the account that you're trading. It's important that you respect the challenge you're trading. It's important that you respect the coaching you're investing in. And the only way that you respect that is if you put in hard-earned money. If you didn't care, for example, if you put in $50 in your trading account, you don't care about $50, and you would do that 10 times, 50 times in a row. Just put $50, just put $100, like so many times in a row, because you don't expect it, you don't respect it. But those things accumulate. It's better for you to stop yourself from doing anything practical, educate yourself, and then invest one time properly invest in your education properly, invest in your trading properly, invest in your account properly, and don't play games with money, because at some point you get addicted to just touching the MetaTrader, just opening positions, just depositing money, depositing $50, depositing $100, buying 10K accounts, buying 10K prop firm challenge. Do it once, do it maybe once or twice, but do it like properly. Do it with time that you respect, with money that you respect, with effort that you respect. Do it intentionally. Exactly. Yeah. Okay, guys. So I think that would be all from our side. And now we can invest in $50 in community intentionally. How to stop demo account addiction. Demo account addiction is also real. Like if you're used to, for example, doing 100K, 200K demo account, and then you go into a real account, which is only $100 or $1,000, then your numbers are kind of screwed because you're used to very other results and very other positions and stuff. So one thing I would never recommend is doing a demo account of a size that you don't trade. If you, for example, intend to do a prop firm account of 100K, then it makes sense for you to do a demo 100K account. It makes sense because you need to get used to the numbers. But if you know that you just want to deposit $500, let's say, or $1,000, then it doesn't make any sense for you to trade a 100K account, because your mind, your eyes, it gets accustomed to those numbers. So get your mind, get your strategy used to the numbers that you actually want to trade. Just any prop firm, FTMO was legit. A lot of people say funding pips was good, but you should be careful about the consistency rules and stuff, because as far as I know, FTMO doesn't have consistency rules, but most of the other prop firms do have. But FTMO doesn't have the best payouts. They do like bi-weekly or monthly payouts and stuff. Many other prop firms do daily or weekly payouts. Ola Prime is also a good solution. I think their challenges are also a bit cheaper. But yeah, funding pips is also good. I might also get a code for Ola Prime soon, but I will also share that in the stories. Like some what is it called?